Good morning, everybody. Welcome to the Flow Show. It's Friday again. The clock doesn't seem to stop, seems to be speeding up. It's like sand going through your fingers. Another week flown by, absolutely flown by. And I'm all alone today. They've left me, the guys. I'm all on my own. They've got Kay and Stell have got a couple of appointments that they had to get to. So I'm here all on my lonesome. No interruptions, no bad jokes, just me, the news, and you guys to keep me company. And I'm welcome for that. So good morning again, and let's get stuck into stuff. We've had a round of PMIs today, and they've all pretty much gone the same way. But we're going to start off in Tokyo. We had the Tokyo CPI numbers for February coming in a little bit softer, actually. Core CPI 3.3% as expected, but down from the 4.3% prior. Same in the headline CPI number, 3.4, down a whole 100 basis points or percentage points from the 4.4 prior. Now, this is just for the Tokyo area, which is obviously the largest populated area. So it's not the full CPI, but it has a heavy weight to it anyway. The unemployment rate, though, in January coming down to 2.4%. So on the jobs front, things are looking pretty good. Coming into today, and as I say, getting through the PMIs. So a further improvement in services to 54 versus 53.6 and 52.3 prior from Japan as well. We'd previously seen that manufacturing not quite as hot. Hong Kong, seeing it decent in there. As you can see, services Ireland much better, services China much better, services India much better. All the services industries across the globe, and until you get to Sweden, are coming in much better. Spain higher as well. Italy, the only one really letting the side down, coming off a bit softer than the expected number. Still up on last month. But a bit behind, lagging behind. France improving. Germany, final number, a bit softer than the flash number and expected 51.3. Still a modest improvement though. The pan-Eurozone number, a little bit off the flash number. Again, still up over last month. UK following suit along with the rest. PPI numbers from the Eurozone as well, down 2.8 on the month and down up 15% on the year, both lower than expectations. So that may signal a bit of a drag coming into CPI numbers from some of the countries. We've already seen Spain and France posting hotter, and Germany posting hotter CPI numbers, but these Eurozone numbers obviously account for all the countries in the Eurozone. So it's not all going to be pulling in the same direction, at least to the same degrees. Back in China, and we've had some comments from the central bank governor Yi saying that monetary policy has maintained sufficient support for the economy and that 14 RRR cuts, reserve requirement ratio cuts, have released more than 11 trillion won in liquidity. The economy is improving, but there are still uncertainties. Will adjust monetary policy in a timely way. The RRR below 8% provides support for the real economy. The current RRR is 7.8%. And just for those who may not know, this is one of the key rates, if not the key rate, if you like, for China and whether they're easing or tightening. The reserve requirement ratio is the amount of cash banks need to keep on their books free to cover any sort of problems going on. And if they need to loosen, if the PBOC needs to loosen policy, they will lower the ratio, allowing the banks to put that cash to work in the economy. If they are tightened, they raise that rate, banks have to bring cash in to their books. So that's why it's seen as the main rate, de facto rate, if you like, for what's going on in China. Now, still coming into this year, people were expecting that they would be looking to cut the RRR again, maybe end of Q1 into Q2. These sort of comments tend to suggest perhaps they're happy to leave the rate as is. As we've seen, the PMIs have picked up really in a big way. So there is some signs that the economy isn't going to perhaps get hit as hard by that COVID wave late last year into this year that some expect. So we'll keep an eye on that. Inflation will be an issue for them. As mentioned yesterday, they are happy to stick with their 3% inflation target. But if they're lagging behind everyone else in coming out the COVID wave, we may see inflation picking up over there like we have in other economies, and then we'll have to look at what the PBOC want to do with that. Moving over to the Bank of Japan, and there's been a lot of stories. There's been a few stories out just about how things are viewed after we've had all the comments from Ueda and his hearings. Bloomberg have comments from people who say that BOJ watchers see a higher chance of a June shift after the Ueda hearings. But I have seen others saying that a lot in the market still expecting the Bank of Japan to do something. A lot thought that his comments were pretty much in line with what we know from the Bank of Japan already, i.e. Kuroda-like, and some even thinking that it was a more dovish slant than perhaps Kuroda. But in the main, it seems that the market, after those comments, has heard everything. They still think that the Bank of Japan is on the path to changing tack and maybe looking to change monetary policy towards a tightening stance. As we've already mentioned previously, they're not going to turn up one day and chuck a rate hike in. It's going to be a slow process. But as we know, even simple language changes at the Bank of Japan can bring big moves in the yen. So we will watch with bated breath as always. One of the measures to see what people think about the Bank of Japan is that their bond yield was pushed above the 0.5% YCC top again, and that forced the Bank of Japan to come in. So the market again pushing the Bank of Japan, pushing their buttons to see if they're going to start changing policy again and do something with the YCC, abandoning it, moving it again, whatever. The market hasn't dropped the bone even after all those Ueda comments. And on the inflation front, PM Kishida has asked his ruling party to compile additional measures to curb the impact of price hikes. And the Chief Cabinet Secretary Matsuno said we'll consider taking necessary steps to curb inflation, including using a reserve budget. So while every other central bank is tightening policy to try and combat prices rising, the Japan government knows that these prices rising are on a domestic level, and they're going to try and do stuff fiscally or otherwise to try and negate some of those price pressures. So it's almost working against what the Bank of Japan may need to do if inflation becomes embedded and they need to tighten policy. So we'll have to wait and see what they're going to do exactly about that. As we know from the Eurozone, we've got the ECB members like Lagarde calling for governments to ease off support for consumers over higher things like energy because it's bringing inflation. So it's could be a bit of a mess what they're doing in Japan. They want to stop inflation, but they want to get inflation too. So trying to get the right inflation is probably going to be a fool's errand, but that's Japan for you, and we'll see what happens with them. RBNZ's OR said he's seeing the early signs of price pressures easing, and didn't believe that tightening sooner would have had that much more impact. The RBA, according to a Reuters poll, are going to lift rates to 3.6% next week and finish at 3.85% in Q2. So that's expecting a 25 pip hike next week from the RBA, and then another one after that to finish at 3.85%. Current probabilities has that 25 pip hike at 75.2, and we're pricing unchanged on the other side at 24.8%. We'll have to see whether the RBA agree with that or whether they are going to think that rates may need to go higher than 3.85% as the market expects. And speaking of expectations, all the banks have their TIPEX out. Credit Suisse has now raised the ECB terminal rate forecast to 4% from 3.5% prior. They now see a 50 pip hike from the ECB in March and May, followed by 25 pips each in June and July. They're not the only bank who are raising forecasts for central banks, as I'll point out in a moment. The ECB released their minutes yesterday, and the general gist was that further increases were required for policy rates to enter restrictive territory. Policy rates were at present barely consistent with the range of estimates for a neutral rate. Now that's a bit of a key comment there, barely consistent with the range of estimates for a neutral rate. The view was expressed that there continued to be value in front-loading hikes at a present stage. Reservations were expressed on proposed communication of an intention for the March meeting. So two things there. The policy rate at present barely consistent with a range of estimates for the neutral rate. That's the ECB noting that the market is not buying into where ECB rates might go. This is one of the reasons why we're hearing constantly, daily, from multiple ECB members about rate hikes continuing. Lagarde saying we're going to get a 50 in March, and all the others saying that they may do more. The ECB is all about getting the message through. They don't want to let the market do what they did to the Fed and start pricing a pivot and not expecting rates to go as high as they said they were going to go. The ECB will fight that far harder than the Fed will, and they're continuing to do that. And there's an interesting comment, the last one, about reservations were expressed on proposed communication of an intention for March meeting. The ECB have always had a policy where, well, certain governors, heads, Draghi's and the like, won't pre-commit to rate hikes. Well, Lagarde did just that several months ago, pre-committed pretty much to 3 50 pip rate hikes. And some, at this meeting at least, have popped up to say that they weren't happy with her doing that and pre-committing to numbers at meetings. But she's the governor, she's the one in charge of the sunbed salon, so at the end of the day, her word goes, even if there's others who may disagree with that. Further in the minutes, there were some comments from Schnabel, who said that the Governing Council's previous monetary policy meeting, that's the December one, had left a visible footprint in euro area financial markets, with a welcome increase in real interest rates to levels that were more consistent with a timely return of inflation to the 2% target, i.e. the market had scaled up where it thought rates might go. And then she said, however, while the terminal rate priced in the euro area in the overnight index swaps forward curve had edged up initially, a sharp decline in expected inflation on the back of lower gas prices and inflation surprises to the downside had later contributed to market participants revising down their rate expectations. Expectations of rapid disinflation had also induced markets to price in material rate cuts as of 2024, suggesting that they judged the period of restrictive monetary policy needed to rein in high inflation to be relatively short. So again, they are noting there about what the market has been doing. It's been saying, yeah, rates are going up, but we don't think rates are going to go up as far as you think. So financial conditions are still a bit lower, and that the market is perhaps getting too optimistic on whether rates might come down. So again, they are noting that the market is not getting the message from the ECB. So what does that mean for us and trading? Well, it means that unfortunately the barrage from ECB bonds is going to continue, and it's going to continue reinforcing that message. It also means that we may have a similar situation, maybe not to the same degree, where the market isn't fully pricing where ECB rates are going to go. I'm not suggesting we're going to get a pivot situation like we did from the Fed, where the dollar came right down and yields came right down. But even a small period of that happening in euro rates is going to get the same result. It's going to get the ECB talking strong. It's going to get the market perhaps having to reprice and push the euro and push euro yields higher. But in the current environment, we've already seen that. We saw the Fed a couple of weeks ago having its higher for longer move with yields bouncing, as now they're above 4%. And we've seen this week and last week the Eurozone and UK yields also getting the higher for longer message. We just don't know whether the market is happy with its pricing or whether it's going to be forced to do more. That's what the ECB is going to be looking at. That's what they're going to be focusing on at their next meeting, making sure the message is across and that the market is pricing the ECB properly. So that's where the trading difference will come in. If the ECB think that yields at their current rates and the euro at its current rates is reflective of their policy, they've got nothing to say. If they don't think that's the case, they will push hard, they will be hawkish, yields will rise further. That might in turn send the euro higher as well. So that's what we need to learn from all these comments, from these minutes, why the ECB members are all coming out and saying these same things. And just to add to that, so we have had a flood of other ECB members. ECB's Wunsch says sees 4% rates possible if inflation stays strong. Vasile says sees more interest rate hikes beyond March. Muller, most likely the March hike is not the last. Even De Guindos, the path of future interest rate hikes after March will be data dependent, but cannot say how high rates will climb. That's those comments coming this morning. So as I say, re-emphasizing what the ECB want to do with their language. Now coming back to the data, and yesterday, another bit of a surprise number. We got a bit of a surprise dollar move, yield move on the ISM, with the prices paid component being picked up by the market as a reason to send yields higher and the dollar up as well. Well, we got some Q4 unit labor costs. Usually these pass by without much of a gander from anyone, but these were final numbers. It came in at 3.2% versus an expected 1.6%. So the market once again took that as an inflationary pressure coming in, that's going to be filtering through into the new year. And that finally did for the 4% mark in US 10-year yields, and we nearly got up to 4.10%. So again, another data reaction, much like we saw previous days, as I say, with the ISM manufacturing, that number, prices paid number, took us up there. This unit labor costs took us up there. So the market is still trading this data very strongly. And today we get the services ISM as well. So look for a similar theme. Very strong number last month. And we're looking to pull back a tiny bit to 54.5 today. Let's just show you that there. There we go. So expecting to come back a bit from 55.2 to 54.5. Now this was a real strong number last month, so maybe justified we see a little bit of a pullback. How far it pulls back is going to be interesting. If we get a move that really undoes a lot of this bounce from last month, i.e., let's say we're really down back towards the 50s, that's going to get people thinking that the January number is a bit of an outlier. That'll put some questions onto the NFPs, which were also an outlier number, that 517K we got in January. Again, look at the components. Prices paid are going to be interesting, obviously, and look at the unemployment number as well. If we get a really bad number here, that's going to put some worries into the NFP expectations next week. So a lot to keep an eye on. Data is going to be market moving once again. And on Fed rates, JP Morgan also getting the Tipex out. They now see an EC, sorry, this is for the ECB, sorry. They also see the terminal rate going up by 25 pips to 3.75 from 3.5% previously. They see the ECB raising by 50 in May from an earlier forecast of 25 in May. So a lot of the market now switching to 50 pips coming in May from the ECB. Sorry, now back to the Fed. Bostic, he favours a 25 pip hike in March, but he's watching the data. And Fed's Waller had a bit of fun yesterday. He says the Fed may need to raise rates beyond December's central tendency view, i.e. the dots, of 5.1 to 5.4% if incoming job and inflation data does not pull back from strong readings for January. So again, those dots expected to go higher in his view. And his interesting day was because he was supposed to be doing a Zoom conference yesterday where these comments were coming out, but apparently he got porn bombed. Someone popped up on the Zoom playing a load of porn, and they had to cancel it and switch it off, and he never got to have that meeting. So that was and that was one of the first headlines I saw this morning when I sat down, and yeah, it put a smile on my face. Porn bombed. There's a new one for you. What a world we live in, eh? So that's all I've got on the headline front, at least for today. So we shall have a look at what's been going on in markets, because we've been getting some interesting moves. Right now, US yields have come off and they're holding this 4% mark. I think the real level might be more down to 3.98, because that's where we spent the best part of a week sitting below before we got the break up. So if you want to look at how markets react, we had the break of this 3.98. We held under 4 for a while, not for long, then we busted it. Now we need to see, is the market going to dip back under here? Again, I think it's going to be important for where we close today and close the week. If we close back below this 3.98, that may suggest that we've again done all the pricing we need to do for now until we get something new to change our minds. That will also mean that we're finding life tough above this 4% mark, which may make life tough to push even higher. So the data could be a decider. If the data is pretty poor, we could be back under 3.98, and then maybe we see a bit of ranging going on between these two highs and maybe the 3.9, 3.85% until we roll into the next FOMC. So that's going to be a bit of a decider for a few dollar pairs around, and dollar yen is one of the key ones to watch as well. It had been lagging that move behind yields. When we got up to the 3.98s, we were getting up to the high 136s, 137s. Couldn't go higher. Even when we got that pop in 10s through 4%, didn't really push on here. We got through 137 briefly, nearly to 137.10, and then the wheels came off again and tried again. Couldn't come down. So there's something going on up here at the moment which is keeping it decorrelated to yields in the main, i.e. yields making new highs. We're not making significantly new highs here in dollar yen, and now, as you can see, we're back lower, moving down back towards the 136 area. So we got minor support in and around this 136 level, but it's a bit hit and miss, a bit short term. The main level is going to be down at this 135.30.40 because it was a former break point. So we had resistance up into here before we got the break last Friday up above, and it's already confirmed as support. So that shows you the importance there. If you're a moving average watcher, then keep an eye on this, because we have the 200 hourly moving average playing as a bit of a support role just in the short term. When things are not so busy, that one's keeping things contained, but also on the 4 hour as well. We've got the 55 moving average also doing a similar thing. So a bit of moving average confluence there. That's coming in above this 135 2030 area. So it could mean if we get any significant drops, that's your first port of call, around about 135.50 on the 4 hour, and it's around about 68 on 70 on the hourly chart. So if you're looking for quiet areas, like the market's not doing too much, where the price may hold up, the evidence suggests those moving averages are a place to look. So if you're short off the top here, that's an area you may want to look to take some off just in case we don't get through. Conversely, if you're scalping away, then it might be worth looking at those for your long scalps off of that. I did get in a last short, and I'm calling it a last short because I'm still short from 132s, 134s, near 135s. So I'm a last short up here. I've got a final stop on those longer term positions at 137.25 now. If we hit that, I'm out of everything. I've been feeling wrong for a while, and I don't want to let this trade get away out of the strategy and into the I hope it comes back type scenario, because hope isn't a trading strategy. If I'm wrong, I've put my line in the sand. That'll get me out on the stop. I don't have to worry about it anymore. I don't have to sit here thinking, oh, I hope it may come down, or I'll just sell a bit more in case it drops a bit and I can make it all back. No, if I'm wrong, I'm wrong. My stop will get me out. But I am short up here, have been cutting it. I've got a bit of on as a short term, and I do want to stick some in the bottom drawer with the rest of the shorts while we're holding below here. But again, I may look if I see something down in the 134s and I can get out the whole trade at a better average, maybe not lose as much, or get somewhere close to break even, I may decide to do that. So this trade now is not all about trying to make money. It's about maybe not losing as much as I would have done previously. Sometimes that can be as good as a win, just reducing your loss. Don't always have to make profit, especially from a losing position. Looking at euro dollar, a bit of a snooze fest going on in this one. So even while those yields in the US have broken up, we couldn't get down to even close to these prior lows in the 105s. Did have a little dip under 136, but it hasn't lasted long. We've got a bit of sideways action going on here. 107 is the marker on the top side, this prior low, and into 105s is the markers on the downside. And as I mentioned yesterday, what I'm seeing in a few pairs is that when we've got big levels like this 105, we're just not getting that close to it. Usually if you get a real test, it's going to come down to maybe 105, 10, 15, even 20. That would be a first test of the level, but we're just not getting down there. And I'm seeing that in pairs like cable as well. If we have a look, a lot of people have been waiting for this 119, but we're just not getting down there. 2025 is where the protection's coming in above these levels. And as I say, usually you'd see it much tighter, maybe 10, 15s, you'd see where those lows are made out. So that can tell you something from the price action, that maybe there's some heavy interest in buying off this 119 level, and that's where it's sat around the 119.20s, or that the selling interest isn't really sufficient enough to really trouble that area. But there's no real gumption behind it to really push the market down. And there's maybe a few factors behind that, as we've been saying this week. European yields are now pushing up as well alongside their US cousins, so that's going to be still supported, put a bit of support in these currencies versus the dollar. Hence why, again, US yields have hit new highs, but we haven't hit new lows in other dollar pairs. So it's significant to keep an eye on that price action to know what's going on. Euro sterling, it's having a little bit of a bleed lower after trying to get up close to 89 and above 89. The resistance there is solid again, as it has been previously, going into the big figure. And even just above. So we are dribbling lower a bit, just bleeding out again. We've got the margins now down to 88. We're probably going to be looking at this area here around 86, 25, 30. Always a place where the price tends to do something. So I'm expecting that to show up again. Then we play the same game down below 88. Can we break 88? Then we have a look at this zone again, which held perfectly by 5 or 6 pips, and I'm completely missed this one. It was an area I was looking to add to longs, and I don't know how I just missed it completely. But I was in at 88, so I managed to get some off up near the top here anyway. But I'll be looking to do the same, maybe add back in at 88 again, or I may try and push to see if we get a move back down to this area. But for now, the range is holding. And when you're trading, sometimes it's nice just to find a decent range and you trade between it. Aussie dollar still looking undecided from here. Can't get and hold back above this old fib and this break level, 67.80, which is a concern. But we are seeing a little bit of a step up off the 67 handle now. We had a couple of goes, then we've seen just a little step up where the support is around 67.0810. So really, it's a coin flip from here. We need to get above this 67.80 and more so 68. That'll take or start to take some of the pressure off this drop that we've seen from the 71s. If we can't do that, we're going to have another look lower. And then it's going to be a game of which door lets us in. Will it be the door up here for a move higher, or will it be the door down here and we get a move lower? On balance, I think we're still pretty bearish in this. I would not be surprised if we do break down a bit further. But watch this. The longer we stay above this area, the more times we see support coming in, the greater the chances that that sentiment switches, and then we become more likely to break higher. Where we go from that, anyone's guess. All the hard work will have to be done again at the prior levels that we saw on the way up here and on the way back down here. So all these levels will be coming into play once again. $1 I'm going to look at quickly, and I'll take some of your requests and questions. So with that news from the PBOC last night and with the improved data, the one has been strengthening, but it's not been one-way traffic. You know, we had this move down, we've had this move up. It dipped a bit quite significantly yesterday and this week. It has bounced a bit. I am still neutral here. We're messing around with this 91 level, so this could be a bit pivotal once again. I've not really got an interest to do here, but I think, again, on balance, we're likely to see more downside coming here if the economic data keeps holding up and if the PBOC more rule out any further easing and if the market changes its mind on that. If we do get any sort of move back up towards these highs, towards sevens, I'm going to be looking interested in getting into shorts if that data holds, because then I think we could potentially see a significant move all the way down, maybe to back down to the 670s even further, if China is going to be booming, if you like. So let's have a look at some of your comments now. Oh, let's go back. Brian, oh, thank you for joining us late in your day over in Cali. Yes, the recordings will go up. Keep an eye on social media. We post when they go up. They're also available in the ForexAnalytix YouTube channel. As soon as they're posted, you can find them in there. Understandable, you can't always stay up at 2:30 in the morning, and thank you very much for the fact that you do. But yeah, always on the ForexAnalytix YouTube channel. Just look under videos, you'll find the Flow Show channel there as well. Ali, oh mate, oh jobber mate, I'm going to call you the jobber Ali. You're short on Kiwi 62.50 today. Let's have a look at the old Kiwi. So it's been a pretty similar theme to the Aussie dollar, but it has managed to sort of break above some short-term resistance here, but couldn't stay there for long, and that's getting up towards that 63 area. So again, a bit in a balance for me, but it does look a bit more constructive. We're holding above the 61.90, 62 area. So if you're short as you are, you've got to be careful. You know, you need a move down under that area, really. If you don't, then we've every chance of getting back towards those highs and maybe even pushing higher. So despite it does look similar to Aussie dollar, this one does look a bit more bullish, at least in the intraday picture, in the short-term picture, because we're not getting back down to those lows, even close. This 62 level is key once again. So above there, we'll keep the upside more in play than the other. But I hope you get your exit, mate, and make many pips. But, you know, if you haven't already, look at this zone, the 62, 61.90s. If you get a move down there on the data, it might be worth looking at maybe perhaps taking some profit on the table. At least you can reduce your risk, maybe bring your stop down a bit, lock in what you've made just in case it pushes higher. But that's just the way I would play it. I can't give you any advice what you should do. That's just how I would play it. You've been banging your drums about Euro Swift long, still holding a trade from 100.30, got to break even, still holding, stop is 98.20. What should I do? Should I lessen my position or should I hold it? I know it's downtrend, but will spark higher if SMB does not beat bear market expectations. Well, again, you're in a trade that's, you're long pretty much at the top. It's been fleeting into here. So I mean, I don't know why you wanted to buy it at the top here, but certainly it's not looking very good at the moment. Yeah, your stops at 98.20, so just below this area that we see down here. I don't know. The Swiss is a funny one to trade. We know the SMB is on both sides. Their meeting is coming up in March. When is it coming up? The 23rd, so just after the Fed. A 50 pip hike is now expected, and it's a 99.1% certainty. But as we've seen, we're not really moving on rate expectations in this one. So I don't know what you're going to get out of the SMB, even if they hike by 50, unless, well, if they hike by surprise and go to 75, then this is obviously going to come right down. So on balance, if I had to call it, I think you may be on the wrong side of this one, at least for the reasons why it may go down more than it may go up. But it's up to you what you want to do, mate. You've got your stop in play. You can either leave it to your stop. Maybe if you get another rally up in the hundreds, if you're not sure about the position, then take it off for a smaller loss. Go back to the drawing board. This is a bit of a similar situation to my dollar yen shorts. I'm offside. I don't want to go too much further offside, so I've got my stop in play. But if I get an opportunity to get out the trade for a lesser loss than I'm sitting in now, something you have to look at and consider, because a smaller loss is better than a bigger loss. But this is your trade, mate. You had your plan from the start. You can either stick to it or adjust it, depending on your risk parameters. Either way, I wish you good luck for that one as well. If ECB is hawkish, what about the Fed, US PPI, CPI, inflation, and market Fed expectations? In today's lecture, you're discussing ECB hawkish, but what about if Fed inflation doesn't go down? Who will win, ECB or the Fed? The Fed will win. It's winning at the moment, even with the ECB turning more hawkish or the market buying into the narrative of the ECB turning more hawkish. We're not seeing euro dollar rise to new highs. So the dollar and the Fed is still the only game in town. But again, you have to look at what the crosses are doing, because while it's not just a Fed versus ECB story, it's a Fed versus Banxico story. It's an ECB versus BOE story. It's a BOJ versus everyone story. So straight dollar-wise, it's going to be about the Fed. If the Fed go on pause, or if they don't push the dots up, if they don't move rate expectations higher than they are now at their next meeting, then you're going to see euro dollar gaining. And that won't be because what the ECB doing. It's going to be because of what the Fed isn't doing. So the Fed, 9 times out of 10, is going to be the mover for these things. And you watch the data. If US CPI comes in weak and Eurozone CPI comes in strong, likely it is euro dollar is going to rally. It's pretty clear at the moment what the markets are doing on each particular piece of data. So there's your trade, and what you do from that is you look at your charts and you see the levels you want to trade at. Let's say euro dollar at the moment, 105. I'm still waiting for a move to 105. This is my area of interest where I'm looking to potentially buy it. I'm happy to buy it now, but it depends on what happens. If US inflation jumps back up to 10%, I may not be so keen to buy at 105 here, because at that sort of level, the Fed might be forced to hike to 6%, and we could see euro dollar down to the 103s. So I'm happy to trade it sitting here now. But as always, I always judge a trade on its merits at the time. I don't need to blindly buy it here in 2 weeks just because I said I'm buying it now. If we get down here, I want to know why we've got down here, and that forms part of my trading plan and strategy. And I ask the questions: am I still happy to buy it down here? Because everyone wants to buy it down here where it's trading at 106. Everyone wants to sell it up here when it's trading at 106s. But what happens if this shoots suddenly up to here? How many people are then going to go, oh yeah, I'm going to sell it up here because I said I was going to sell it when it was down here? The market always changes. People always change their mind when you get to the crunch time, because if we're back up here, something has happened, something has changed. You might not be so willing to sell it up here now. So you always have to judge a move on its merits at the time. What is the driver behind that move? And if you're still happy with it, then you trade it. If you're not happy with it, you don't trade it. And it doesn't matter if you've waited 6 weeks to get up here or 6 months to get down here. If you don't like the reasons why it's down here, then maybe you don't trade. And if that's the case, you move on and you find the next level. You don't have to trade a level just because it's there. But then there's a contradiction. Sometimes you can't help but just trade it. Anyway. Gavin, 137 is where the drop came at the from at the last BOJ meeting. When was that? This December one. Were we up there? Yeah, so it was. Yeah, that meeting was on the 27th. Was it 27th December? So yeah, that was the crunch area time, wasn't it? Right there. Was it 20th? It was just before Christmas, wasn't it? So yeah, 137. So yeah, as you know, Gavin, this is a big area up here. I mean, I still see 138 as a bit bigger, which was just above there, as you can see, coming into the latter part of the year. But yeah, that was the big breakdown, and we are, that's why I've got a line in there, because we are finding trouble against it. And we've got the Bank of Japan coming up, so it could be another one again. Kuroda's last meeting. If he does something here, then we've got another significant top in play, because this will be back down at 133s, maybe even more. DJ, do us a favour and cut your short so the pair will start. So the pair will start going short. You know it, mate. I will tell. Obviously, I tell everyone I put it in the trades room. For transparency and accountability. I put it in our trades room in the room when I get in, get out, chop, slice, whatever. When I've got orders in and whatnot. And yeah, you guarantee as soon as if I get stopped out at 137.25, I will guarantee you that will be the high within 10 pips for the next year. Always happens. A trader's folly, trader's luck, as we call it. But it all happens to you as well. As soon as you get stopped, it will mark a top or a bottom in the pair. I should do a survey one day, and I bet you it comes up at least 80-85% of you see the same thing. Shit happens. And this is a headline in here: regret. Many Brits are suffering from Brexit regret. Can you confirm? Brexit regret. You know what? You can always go backwards in your mind. You can't go backwards in real life. There's not many things in life I regret. I voted for Brexit, not because of buses and silly promises from politicians, because I thought that the Eurozone project was a good project being executed badly, and has been executed badly for donkey's years. And so I voted for Brexit. And we've got Brexit. And you know what? What's changed for me since Brexit's happened? Nothing. Nothing's changed for me. I can still go on holiday to Europe. I can still go traveling. I can still buy stuff in the shops. People, every time there's a shortage in the shops, tomatoes, sausages, whatever, people blame Brexit. Well, it's not all Brexit, because everyone's suffering from the same supply issues due to COVID, due to China, due to the Ukraine war. So it's an easy excuse for people to use. Oh, it's Brexit. And you'll hear it every time over here in the UK. Something goes wrong. Oh, it's Brexit. Well, it's bollocks, quite frankly. My life hasn't really changed. I've not seen any real significant impact from Brexit, apart from having to use a different lane when I go on holiday. Well, if that's the worst that's happening in Brexit, I'll wear that. Thank you very much. Brian, thank you for the tip. Can you give us your read on dollar Swiss? So dollar Swiss is the anti-euro dollar, if you like. If euro dollar is going one way, this is usually going the other way. But yeah, it does trade on its own merits. A lot of people were looking for this 93 area to short, and it went above and kept going. Again, it's not one I'm trading often. I find it difficult to trade this one when I know that the S&P is on both sides. So if you get any significant rally, suddenly it gets hit, and you know, then up pops the S&P. Might have intervened. Same way if you get down to the lower levels, they step in and trade both ways. They're really the only ones who are making money in this one, probably more so than the rest of us. What are you? You've been playing long lately. Okay, so you've pretty much been on the right side of it. Hopefully you're long well below 93s and right down here against this, what could be called support down here. But it seems like it's running into a bit of stiffness up here in the 94s. Let's come zoom out a little bit, see what we can see. So it looks trendless to me, really. You know, a fairly tight range we've got going on here. Got a bit of an uptrend at the moment on this one. That moving average up there, the 100 moving average, obviously capping stuff for now. So that's your reason why you've got a bit of a top. You can see it's a bit of a natural top. Prior highs up there as well into 94.5, 94.60s. So if you're long side, this is where you've got to break. Get above here, then you may be heading up for 95s, 96s. If you're long, you've got to be careful that we're not breaking these levels. So this is sort of the area, again, a bit like Ali. If you're up here and you're not chewing through it strong enough, maybe take some off the table, bring your stop up behind, protect what you got. You can always reload in a dip, even if you get knocked out. Just make sure whatever happens, if you don't go higher through here, you take some money with you. So even if it runs all the way down, go through your stop, you don't lose money, at least you make some. I'd rather make a little than lose a lot, any which way. Let's have a look. Anyone got anything going on? Got my answer. I'm hoping wrong trade. Hope is wrong for trade. Yeah, we don't trade hope. We never trade hope, Ali. Hope is not a strategy. That's why I always say you need your plan from the start. Because if you get into a situation where you're trading, you're going offside and then asking, what do I do now? You haven't got a plan, and you didn't have a plan from the start. You need to know, what do I do now before you get into a trade? You need to cover that scenario. What if I'm wrong? I'm doing this trade. I've got a stop. I've got an entry. So you don't need to know what if I'm wrong. You've done it from the start. If you're wrong, your stop gets hit. No one should ask, what do I do now, after they've entered a trade? Because then you're not trading with a plan. So yeah, you got your answer. If you get out for a smaller loss, fine. Sometimes a small loss is as good as a win if it was a bigger loss before that. And I can go back to my experience on the live floor. There might be days where I'd come in on the pit in the morning and I'd just have a complete nightmare. First 20 minutes, half hour, I'd have a complete nightmare. And I'll be down, you know, 20, 30, 40 pips, which doesn't sound a lot, but in the contract I was trading euro dollar, that's quite a lot. And when you times that pips by money, it could be quite significant. And then I'd spend all day clawing that loss back. And if I walked out the pit at the end of the day, sweating, tying it off my shoulder, and I'd got myself back to zero, that was a good day. I'd call that a win, because I walked out of there not losing. And that's the least you want to aim for when you're trading. Don't lose. If you don't lose, you're going to win, because there's only two ways you can do in this business. You either lose or you either win. So if you don't lose, you have a much greater chance that you're actually going to win. So yeah, it's, some people think, oh, I've got to wait for my stop loss and that's it. No, you don't. If you don't like a trade, if it's not working and you were losing 500 quid and suddenly the market moves and you're only losing 250 quid, then you look at the trade and you think, right, well, I could wait and maybe it gets down to back to zero, or I just take the lesser loss than I had 5 minutes ago. So that's, you know, that's always the basis behind my trading. You know, don't lose money. And, I think I should get some stickers done and send them all out to you guys. You can stick them on your PCs. Don't lose money. Sounds simple, but it's hard, and that's why 70–80% of people in this industry lose money, because they don't know how to not lose money. And that's what people need to learn, I'm afraid. Right, have you guys and girls got anything you want to throw up? Because obviously I haven't got the guys and girls to, or the guys and girls, Stel and Kate. I don't know which one's a guy, which one's a girl, but you can work that one out. Because I've not got much more to add to that one. Kate obviously goes through his crosses. Dollar Mex is one iron, keeping half an eye on. Because if you weren't shorting it at this 1850, the 1800 level is the number you need to watch. If you wanted to try longs from that, that's about the only area I would look for longs. Obviously, you're fighting a bad carry if you're long in that position there. But if you want to have a little short-term crack at it, nothing against that. If you get rallies, if you buy off this 18 level and you get rallies, you want to be knocking those out pretty quick, because you can't, as I say, the carry is against you. You don't want to be sitting in trades for too long here. So maybe playing a bit of a rinse and repeat if you find this 18 level is holding up, something to keep an eye on for that one. And Euro CAD is another one. I want to know if we get a move back up to the big strong 146s. This level up here, 146, 46.5, call it. Big strong level. We had a little move up in the 145s, not quite up there. It's come off again since. But if you want to pick places where you want to get a trade in, these are the types of levels you want to be looking at. Level we've all traded here. Level K keeps an eye on quite often. So we've had some decent moves. It was a decent move off that level, but we're coming back towards it now. Can we talk about the trade that exists, non-leveraged, between business to business? I mean, the banks, trade that exists, non-leveraged. You'll have to explain that a bit more, please, Brian, what you mean by that one. Ali says, rules he follows by legend, Ed Sikota. Cutting losses, ride winners, keep trade small, follow the rules without question, know when to break even. Yeah, running trades is do you mean flows, Brian? I.e. where the money's flowing around? Yeah, okay, flows. All right, we'll talk about that quickly, but just to go to Ali's point, riding winners is something I don't see people doing very well. Now, it maybe sounds a bit disingenuous, but if you've got a profit target and your profit target's hit and you take your profit, that's absolutely great. Nothing wrong with that at all. But what I tend to see is people who take profit at their levels and then the trade continues going. For me, riding winners is what I try and do each and every time. In the first thing I do, as mentioned 1,000 times, is I get my risk to zero. So let's say I do a short-term trade. Let's say I sell it here, Euro CAD 146.50 with a 20 pip stop. Okay, I've got the position on. Maybe I go 20 pips in profit. Fine, I can half the trade. Okay, then my risk in one instant is at zero. I've made 20 pips on half. My stop is on 20 pips on the other half. So zero. If I get stopped, zero. Don't lose anything. But what that does then is it allows me to sit in the trade for as long as I can. Because if it comes down another 50 pips, then I can take some off the table. Now I can bring my stop down to entry. Now I'm locking in a profit. If my stop gets hit, I walk away with money in the bank. And what that does is it allows you to stay in a winning trade. You don't have to take all your money off the table, but you do it in a way where you keep protecting yourself as you do that. If you take some off, you bring your stop down. Take some off, bring your stop down. That's what turns some trades I do from 20, 30 pip winners into 100, 200 pip winners. not because I got a target of 200 pips, because the trade has played nicely. It's gone that way, and it's allowed me to push that trade until either I have to take profit because I can't slice it no more, or my trailer gets hit. So if you have, it's fine having targets. There's nothing wrong with having targets, but if you have a target, your target hit, and then you see the trade carry on moving, you have that regret. Oh, why didn't I stay in it? Well, give yourself a chance to stay in a trade by the way you manage a trade. So you want to talk about flows, Brian? Well, just quickly, because we haven't got too much longer. Again, I'm not 100% sure what you're talking about there, but if you're talking about money that flows between different asset classes, we'll look at yields as this current example. Okay, yields are going up. Now you get a certain element of investor who are happy to park their money in government bonds at 4% yield, because maybe they're a bit risk averse investor or passive investor. They're happy, stick their money in US government bonds at 4% and sit on that. Obviously, the higher yields go, the more attractive it becomes. And this was something that one of our guys picked up in the chat room. I think it was, let's see if I can show you quickly. Where are we going? In here. So this is the Flowonomics room, by the way. So it was this tweet here, that the 6-month T-bill yield is on the verge of surpassing the S&P 500's earning yield, i.e. you're potentially going to earn more sitting in a 6-month T-bill than you are sitting in stocks. So this is where flows come into play, because investors see that and they think, well, there's risk in the stock market. So if I can earn 5% sitting in a T-bill for 6 months, I've got no risk. I earn 5% whatever. If I put it in stocks, I may earn 5%, I may earn 2%, I may lose 3% over that same 6-month period. So we've been in a situation where rates have been near zero, yields have been low and near zero. There's been nothing for the passive investor to put their money into and just sit and earn a yield. Now we have got that situation. So, you know, people want to know why the stock market may go down. The stock market may go down as yields go up, because people are moving out of stocks into more passive investments where they can earn a straight interest rate. You know, it's effectively putting it in the bank and earning interest. So these types of flows are what happens behind the scenes. This is what investors do. You've got risk investors who may be happy to go into stocks or go into higher yielding assets like corporate bonds. You know, very higher risk those are. You know, all different types of investors have different appetites for risk. And when you get different moves in markets, bond yields going up, you get a shift around of those asset flows. People think, oh, the world's a better place. I'm happy to put money in greater risk. And they'll look for higher riskier assets, and that boosts that field. But then you also get people who say, wow, the US Treasury are going to pay me 5% to sit on my money. And for the last 10 years, I was paying them because bond yields were negative, like in Germany, or they were close to zero. And by the time you took out the costs, I was paying the Treasury to hold my money. Well, now they're going to pay me 5%. And banks are doing that as well. You know, this is an issue that the Fed have got. They're paying out billions in interest because rates are higher on their overnight reserves that banks park at the Fed. So they're earning money off the Fed. All the support they got through QE, propping up the banks, now the Fed are paying them for banks to sit at park money at the Fed. So that's something the Fed needs to address. But that explains a bit about flows, where investors put their money, what the banks do, and how they shift stuff about. I hope that's given you a bit of insight. How does it impact retail? It impacts retail because what they do moves markets. If money's flowing into US yields over European yields, that's FX. Money's coming out of euros and going into dollars. That impacts us because that's what moves the price on our screens. You know, that top tier of the market, and we're 100 rungs down the ladder in terms of liquidity. So, you know, that's why you get these big flows, and that's why you get the trends. It's not the text on your chart, by the way, that make those moves. It's big investment flows finances moving about. Tina is no more. Exactly, Gavin. There is no alternative. Tina is out the window. There is now plenty of alternative to that. Anyway, oof, didn't do too badly, did I, for being on my own? That's the end of today's show. As always, I will thank my two guests, Kay and Stel, for their input this week, wherever they may be, probably down a pub having a beer when I'm working, slaving my guts out for you guys and girls. Thank you as always for coming to the Flow Show. Your support is greatly appreciated every day, every week. You guys and girls make us what we are today. I will pop this link if you do want to come and join us in the chat room where you can hear our wafflings all day, every day. There's the link there. Please use code FFL20. We'll get you 20% off the price of subscription for as long as you subscribe, and that's off every price plan that we have there. So please have a great rest of your day. Watch those ISM numbers, could be a bit volatile. Hopefully you make lots of pips. Remember, Friday's pips is beer pips. Have a very safe and peaceful weekend. We shall see you all on Monday. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.